Welcome to Come Learn Forex. In this video, we will be looking at lots, margin, and leverage. Please pause the video to have a detailed read of the following disclaimer before moving on. So what is a lot size? This refers to the volume exchanged. One standard lot, or 1.00, equals 100,000 units of currency. This means that a movement of 1 pip, or 0.0001, is worth 10 of the quote currency in a currency pair. Please note that lots will be dependent on a lot of factors taken into consideration, but for the purpose of this video, we will use 1.00 standard lot as a base value. Margin is the required balance that your account needs to have in order to maintain an open position of certain size. Without the required margin amount, your account will not be able to open the relative volume of position. Please note that unlike lot size, margin depends on only two things: volume, which is the lots, and leverage. So, what is leverage? This refers to the transactional amount you can use relative to the amount you need to have as margin. This comes from your broker and is effectively borrowed capital. The purpose of it is to allow one to trade without having all the required money as margin. For example, at a high street exchange bureau, you exchange your money at 1-to-1 leverage. Your average broker will offer leverage from 1-to-1 to 1-to-50, with some offering more at 1-to-100, 1-to-200, 300, 400, and even as high as 1-to-500. Please note that leverage is a double-edged sword, as indeed it allows for greater gains with less capital exposure. However, one must understand that it also allows for greater losses. Therefore, one needs to comprehensively and consciously choose the leverage to transact with. On a further note, this means that the higher the leverage will not necessarily mean the better. Please consider using appropriate leverage as to your desired market exposure. If you have enjoyed this Forex-related content, please do not forget to like and subscribe. Also, comment below on what you would like to see next.